Hi, this is Jeremy Peterson with Vesta Real Estate here in Ogden, Utah. It's May 2018 and we are in the midst of our spring selling surge. Buyers are out in the market in droves, placing multiple offers, getting in bidding wars. Sellers are receiving multiple offers and getting prices beyond their ask price in most cases on their homes right now. This is a flashback to last year and even the year before with the sales cycle. And so this spring is turning out to be a mirror copy of those past selling seasons, and people are kind of wondering what's going on. The big question in the market right now is how much higher can house prices go, and when will there be a shift in the market away from sellers and more towards buyers? Those are million-dollar questions, and I'm going to make an attempt to answer a couple of those with some evidence that I think seems to point the way with that. So first off, let's talk about what's happened with house prices. And I'm going to cue our first chart here. As we look at this chart, you can see the real estate bubble in 2007 and its collapse down into the trough in 2012. And then since then, prices have just been on a straight up trajectory to the moon. A lot of this has been driven by low interest rates and some other factors we'll talk about in a moment. But what you don't see in this chart is what happened to housing prices between 1992 and 1999. If I were able to get that chart and show it to you, it looks a little bit like what we're experiencing right now, which was a very significant and steep increase in housing prices over a long period of time. So we seem to be copying that pattern a little bit with our current run-up. So why is this happening? Why are house prices increasing right now? Well, first off, we are creating a ton of jobs in this state, and people are moving into Utah to fill those jobs, and they need a place to live, and we have not been building enough homes to accommodate them. In fact, we've been lagging behind anywhere 3,000 to 7,000 housing units per year for several years now in trying to accommodate demand. Some of the supply problems are caused by cities who don't want to zone to accommodate higher density housing so that we can place these new people in homes. Other factors include things being landlocked. There's just not enough land available. Some communities are already built out. There's a number of factors that are preventing builders from building as many units as we need to fill supply. So what happens is people compete and they bid the price up for the limited housing that we have. So one of the things that I've seen in a chart that I created is that there is a pattern on affordability, and that in past cycles, homeowners have reached a level of peak affordability, and then the market seems to shift more towards a buyer's market as that affordability becomes better, and then it turns around and becomes less affordable again, and then the pattern repeats over and over. So what I want to show you is a chart that demonstrates that idea, and this is a mortgage payment inflation adjusted chart. And I could get into the details of how this chart was created. If you want the details, send me an email and I'll explain how this was crafted, but it comes from MLS information, it comes from the Bureau of Land Statistics and a bunch of other things, the Bureau of Labor Statistics, and a few other very nerdy places where you can get information and crunch it in a spreadsheet. So this is great nerd work, and if you like charts, this is your video blog update. So what we see here in this chart is inflation-adjusted mortgage payments for Weber County. And you can see that at the beginning of 2000, that there was a peak in the cost of owning a home, and then the market softened, and then in 2007 you can see there was another peak in affording a home, and then it declined, and it declined in a big way through the recession this last round, and now we've been on a tear upwards since then. But you'll notice that in this chart we have not reached the peak that was reached the two previous times in the market. So keep in mind that this chart is affected by three things. One is inflation, 2 is interest rates, and 3 is the price of housing. As the price of housing goes up and as interest rates go up, this chart moves upwards and vice versa. But all things being equal, if time just moves forward, the chart moves downwards due to inflation. And so I don't want to get bogged down in too many of those details, but the question that this chart can answer for us is how far until we reach the peaks that were reached the last time? And if we consider house price and interest rate as our variables, then there's a couple scenarios. One scenario, if there is no change in interest rates from where they are today, then house prices could increase another 15% before we reach the peak that was reached in previous cycles. That's 15% from today. Now keep in mind that house prices since January in Weber County have already increased about 8%. So that's 15% on top of the 8% we've already experienced. We probably wouldn't see that much of an increase in 1 year. We'd probably break that up into 5 more this year and 10 next year and then call it a day. But time is moving forward and interest rates are not going to be staying the same. In fact, the Federal Reserve is doing a bunch of things and, well, I won't get into a bunch of economic gobbledygook, but there is good reason to believe that interest rates will increase, and the talk is that they will be about 5.5% by the end of the year. So if interest rates increase to 5.5%, what does that do for us? Well, that means that there's only enough room to increase house prices about 3% or 5%, somewhere between that range, 3 to 5% between now and the end of December will be the end of the year when we think rates will be that amount. Now that's really possible because we've already jumped 8% to go up another 5%. That's doable. We've done that in years past. But as interest rates approach that 5.5%, we're going to be in the red zone and peaking out just like we did in previous cycles. So if I were to make my prediction based on these facts, looking into my crystal ball, I would say that things will shift to a buyer's market or begin to shift that direction, will shift directions sometime around the end of the year, and next spring should be a totally different buying environment from what we're experiencing right now. And we may see a shift in the real estate cycle for the next several years. So that's my prediction. If you're a buyer, what does this mean? Well, it means that between now and probably the next year and a half, things are going to be less affordable than they are now. So if you need to buy a home, you should go buy one and take advantage of the tax benefits and the amortization and all the good things that come with building equity and being a homeowner. Don't let my words delay you from doing what you need to house yourself. If you're a real estate investor, well, that's a gamble, like anything in investments. So you have to have a plan. You need to have a plan B as well as a plan A, and just be prepared. Hope for the best, expect the worst, and you'll be okay. If you're a home seller, well, things have been great for you for quite a while, and they will continue to be through the end of the year. Next year, they may not be as great as they were this year. So we'll find out. I could be wrong, but if you're thinking of selling, this spring and this summer may be the time to do it if you're trying to maximize the dollar that you get out of your home. So that's our video update for today. Thanks for tuning in, and if you need help buying or selling a home in this market, give me a call, and we'll talk to you soon. Thanks.